Is a very special section. This is also one of the most complicated. It's not complicated in terms of technical analysis, but it's more complicated when you're trying to manage your own emotions and your own psychology when it comes towards really executing these ideas. Now, this is called how to give your trades a second chance. So whenever we're talking about how to give our trade a second chance, the main concept here is that you have to keep your bias the same, right? The first step is to always keep your bias the same. Now a lot of times what traders would like to do is they would say that, okay, I'm going to take a buy at this position, and they take a buy and price does this, weird liquidity grab, or it retraces more than you anticipated for it to retrace, and it hits your stop. Once it hits your stop, you're like, okay, you know what? I had a buy at this point. It hit my stop loss. I'm going to try to look for a sell. And once you try to look for a sell and you're selling, let's say your bias was correct, let's say your trend identification was correct, which was a buy. Now when you try to look for a sell, the trend continues and it continues up and hits your stop loss, and now you're lost 2 trades, right? And then maybe you try to take a buy after that and you get a small win, whatever, right? So now you have 2 losses. You took a buy, that didn't work out, and then you took a sell, that didn't work out, and then price eventually went exactly where you thought price was going to go. That has happened to a lot of people, and that used to happen to me as well. Now psychologically, that's very, very damaging. You lose confidence, it hurts your ego, or sometimes, you're in a buy position and price retraces, hits your stop loss, and then it goes exactly where you thought it's going to go. That's very, very normal. That happens all the time. Sometimes you can say, oh, well, even maybe I would have had my stop loss a little bit wider, or maybe like a lot of these things go into your mind. So the best thing to do at this point is to just step back and logically look at price, that, okay, if price did went into my favor, it went exactly where I thought it's going to go, how could I have executed on that, right? Like, what could I have done differently? Okay, maybe I could have looked for a second position, or maybe how could I have given my trade a second chance? And whenever you're looking at price in a way where you could have given your trade a second chance, there's always going to be a technical aspect to that, whether it's going to be a candle giving you a buy confirmation, or it's going to be a candle, giving you an opportunity for an impulse entry, which we've covered in the past. All those things are going to happen, and all those things are going to print exactly how you want them to print. Okay, so whenever you're looking at a trade and you're taking a loss on a trade, always understand this, that if price tends to go in your direction, there's always a way that you can give your trade a second chance, whether it's from a candle confirmation or it's that through an impulse entry. So we're going to go over some scenarios and some examples, and hopefully we can shed some more light on how to give your trades a second chance. So in these examples, we're going to assume that price is in a trend, which it should always be in a trend, and you're trying to trade the trend because trend is your friend, and we're not going to fight the trend. Okay, sometimes you may get opportunities to fight the trend, but just don't fight the trend, right? It's just not profitable. So we're going to go over some examples, and this is only going to be when price is trending. So we're going to take a look at a bullish trend, and if you reverse that, it becomes your bearish trend, and the ideas are normally basically simple. So let's take a look at this right here. For example, let's say we have candles pushing bullish, right? We have a bullish trend, candles are pushing up some more, and candles push up some more at this point. And what's happening now is that now you're getting this sort of like resistance being formed up over here. Let's say you have some sort of a buy being formed. Now, just by looking at this, and trend is up, and I know some of you guys have gone through certain concepts and certain market structures and certain ideas. Do you think this is a great idea to take a sell at this point? Do you think? I don't think so. This is not a great idea to take a sell at this point, because for you to take a sell, so now this is basically all side note, right? For you to take a sell in a bullish trend, you want price to basically come down right here, maybe whatever, and then you want price to create some sort of a support if you want to take a sell. This is side note. This is not related to this section where we're doing whatever. So you want price to create a support. Once we create a support, let's say this is also a 30-minute time frame. let's say we've created a support. Now, if price breaks the support, this is where you should take a sell. Counter trend trading. We've went over this. This is when you should be taking a sell. Okay. Now, so we're not going to go into more detail on that. We've already went into detail with this, right? So what we're talking about is how to give your trade a second chance. Now, let's say price is continuing to push down. We are pushing down, in an uptrend. We're making a higher low, and this is where we have created a support now, right? We've created a support, and price is pushing up. And let's say, for example, this is a 40 pip range. You have a 40 pip range, and you're saying that, okay, you know what, there's a high probability for price to go up, and you're looking at some sort of a confirmation, and this is your confirmation where the candle has closed bullish. Let's make this a little bit smaller, right? Candle has closed bullish. Everything aligns in your favor. 30-minute time frame, bullish trend, support formed, higher low formed, and there's a high probability for price to continue to push up, right? And that's where you're executing your perfect buy. Now, for example, let's say that price does not do what you anticipated it to do, and instead of moving up, let's say price wicked down, it broke above this high. Let me remove this. It broke above this previous high, and then price started to continue pushing down, right? And we formed a bearish candle at this point. What are you going to do at this point, right? We formed a bearish candle. Now, this is only provided that now, here's the thing. Whenever you're looking for a buy or a sell, you're keeping the same bias. I cannot stress this enough. You're always keeping the same bias. If you're looking for a sell, you have a selling bias only if price is trending bullish, right? If price is trending bullish and you're only looking for a counter trend sell, you're waiting for the support to break and then you're taking a sell, right? If price is trending, let's say bearish, then you're looking for sells or whatever. But if price is trending bullish and you're only looking for buys, you're only looking for buys. Never change your bias for anything. Never. This is the core value of trading right here. Never change your bias. Changing bias is only left for experienced traders who've seen certain things happen over and over again. So never, ever, ever change your bias. This is the pro tip right here. Never change your bias. Now, let's say, for example, you took a buy and you took a loss at this point and candle closed like this, right? Now you're like, oh man, you know what? I expected price to go up. It didn't go up. Like, what should I do now? The best thing to do at this point is to just wait to see if you have another buying opportunity, how to give your trade a second chance. Now, this may for some look like, oh, we can go down, blah, blah, blah. But let's say, for example, if we do go down, and your bias was bullish, so your buying opportunity never came, so you ended the trade in a loss. Now, let's say, for example, you were able to manage risk, so you didn't lose the whole percentage, you lost a portion of that risk, and that's it, right? Loss is a part of the game. You manage your risk, you lost less than what you anticipated to lose. Perfect. Day closed, awesome, right? Now, for example, instead of moving down, we have a candle that goes bullish. Now, this is very, very, very important. Let's say you have a candle that goes bullish. Now, there are two scenarios, right? There are two scenarios that this happens. Now, if we focus on just this idea right here, don't you think that we have a bullish candle and then we have a bearish candle right here? So we have a resistance form. Now, note this down. If a candle closes bullish, but it's still below this resistance that we formed, this is not a good opportunity to buy because we're still under this resistance. Now, there are different scenarios that we're going to go over, right? So we have to keep making notes, right? If this is a resistance, we're closing below this resistance, this is not a good opportunity to take a buy. The best opportunity to take a buy would be, number one, if this candle closes above this resistance, and now you can give your trade a second chance. Now you can give your buy a second chance, anticipating the next candle to wick down and to continue pushing up, right? So over here we have some confirmations. The first confirmation is that you have a bullish trend. The second confirmation is that we have formed support. The third confirmation is that the candle is closing above this resistance, which is now giving you enough probability for price to continue moving up. Now, another thing, side note. when are big moves supposed to happen? When can you expect big moves to happen? Can anyone answer that to me? Can anyone? There's no one here, it's only me. And you guys watching. Okay, so big moves only happen when there's volume in the market, right? And when do we have volume in the market? We have volume in the market. You have pre-London session, you have London Open, you have pre-New York, you have New York Open, you have NYSE Open, you have London close, you have news happening, you have breaking events, and all these times when there's volume in the market, right? That's the only way when you're going to have a big candle forming. Now, right? First, situation, candle closed above resistance. Now you have a very good opportunity to price to go up. Now, understand this. This is a wick. This is a big wick right here. We can form all sorts of candles, all sorts of things can form, you know, and this is a big wick. Whenever you have a big wick, we've talked about this in impulse entries, you can't take an impulse entry because if you're waiting for this candle to break above this high, then your entry is going to be too late. And sometimes it's going to happen. Sometimes what's going to happen is that you're going to have this candle just move up, break above this high, and then continue to go up. Okay? Now, was there an opportunity over here for you to give your trade a second chance? Your trade has to make sense, right? Logically, market structure, the way the candles are printing, they have to make sense. It's not all the time that you're going to have an opportunity to give your trade a second chance. It's not going to happen all the time. Sometimes it's going to happen. Well, I would say most times it's going to happen. I'd say maybe, you know, the probability, maybe 80% of the time, you're going to have an option to give your trade a second chance. The 20% of the time, you're not going to have an opportunity to give your trade a second chance. So this is when you're going to not have an opportunity to give your trade a second chance because as we mentioned earlier, if this is a 40 pip range and now price has broken above this area, is this a good idea to take a buy at this point? Right? What did we learn in the previous sections? Is this a good idea when price is in the middle of a range? It's not. You know, a better idea would be for price to maybe be closer to this zone so that there's a high probability for it to continue pushing up. This is a situation where it may not work, and I really hope you guys are taking notes. Okay? Now, for example, let's say this wick right here, it was this big, you know, it wasn't that big of a wick, you know, it was this big wick, and if the next candle starts to break above this high to the left-hand side, you can take an impulse entry. Because if we're now breaking above this high, we learned in impulse entries that this is now a really good probability for price to continue pushing up. Okay? This is a really good probability for price to continue pushing up. This is where you can give your trade a second chance. Second chance is that you give the first chance right here. After this confirmation, didn't work, you got stopped out, and now you're waiting for price to break above this high, and now you're giving your trade a second chance. Now, when you're talking about risk, let's say you're only giving your trade a second chance if you still have risk left in your day. That's why managing risk is really, really, really important. Let's say your total risk for the day was 2%, and you took a trade right here. Let's say you put like 1% risk there, and you manage risk. Instead of losing 1%, you lost 0.8%. So you still have 1.2% risk left. And now you're using, now it's up to you whether you want to use the full 1.2% risk or you want to use, let's say 1%, 0.5, whatever. That's totally up to you. But in essence, this is where you're giving a trade a second chance, and this also means that you're taking a second trade. Essentially, it's just a second trade. You know, your first try didn't work out, so now you waited for your second confirmation to show up, and you tried to give your trade a second chance. Okay? This only happens when price is trending. This only happens when there's volume in the market, right? So there are different situations, there are different ways that the candles can print and can give you these ideas that this may work in your favor. Okay, so we have to keep these things in mind. Giving your trade a second chance is a complicated idea. It takes a lot of practice. It takes a lot of sitting around and watching what price is doing. Because here's the thing. Whenever you're going to take a trade, and in your eyes and in your mind, it's going to be a perfect trade, a perfect opportunity to execute. And if price doesn't work that way, all these emotions come in. All these emotions, you're thinking that, oh man, shit, I took a losing trade. Let me take a sell. Let me take a sell over here and win this trade because it's going down. No, keep the bias the same. Just relax. Calm down. And the first way to calm down is to manage risk. If you know that you have managed risk, if you know that you risked $100 and you've lost, let's say, $80 and $70 trying to take a buy, now you're perfectly fine. You're like, okay, you know what? I managed risk and I'm a mature, confident trader. I'm going to sit back and I'm going to see if price gives me a second chance for it to continue pushing up or not. Okay? And this is where these situations are where you can give price a second chance for it to continue pushing up. Okay? Now, there's another situation that happens, and we're going to talk about that as well. There's another situation that happens that, let's say, for example, we have support formed. We have support formed, and the next candle, it forms and it breaks the high. You're like, okay, perfect. We've broken the high. Now we're going to go up. But instead, it starts to break down. It breaks the low right here, and it still closes bullish. Okay, so we have a bullish candle closing. Let me make this a little bit better. That's not a bullish candle. That's a weird looking bullish candle. We have a bullish candle closing like this, right? We have a bullish candle closing like this, and you're like, oh man, you know what? I had a buy at this point. Price broke the high. I took a trade, and price came down. My stop loss was right here, and it hits a stop loss, and now I have a loss right here. And while you're crying about that loss, you see that next candle wicks down and continues to push up, and you're like, oh man, shit! Like, if it didn't have hit my stop loss, I would have had a profitable trade. Now, just at this moment, a lot of you guys are thinking the same thing that I'm thinking, that, okay, if you took a loss right here, and if you managed risk, and also remember, there's always a probability you're going to be able to manage risk. You're not going to be able to manage risk all the time. You're going to be able to manage the risk most of the time, and sometimes you're going to take the full risk on the chin, and that's totally fine to solve our probabilities. Now, you're thinking at this point is that, okay, maybe if this candle broke above this high, we could have taken an impulse entry and given that trade a second chance. And that exactly what we thought it was going to do, because now we gave a trade a second chance and we made some money, or we reduced some of the loss we had over here, or we put the risk that was left from this trade over to this trade, and now it basically worked out. Okay, so these are different scenarios, different things that can happen, and these are things that you notice in the market as you're trading them, because as you're sitting back and watching how price is moving, you're looking at candles, you're looking at the different way the candles are printing, and you're kind of like visualizing where you can see the next candle move, where you can see the next candle go, and once you start to do this for 3 months, 4 months, you start to have an intuition, is what I call, right? This intuition comes over time. Like after watching all we've done over here, you're not going to be able to do or to give your trade a second chance maybe by tomorrow or next week or the week after that. It's going to take you maybe 1 month or 2 months to just kind of really absorb the information and keep watching how the candles are printing, and then you're going to be able to successfully give your trade a second chance. But listen, in the beginning, I wouldn't recommend for you to just jump in giving a trade a second chance, right? Take those losses, but manage your losses. And once price does something that we've discussed here, just take a mental trade. Take a mental trade and watch it. And don't take that mental trade stressing about, oh, I could have been in this trade. That's totally fine. It's totally fine, because you're still learning, you're still progressing, you're still adding these tools to your trading arsenal for you to be in profits in future, right? So this is all a mental investment that you're doing in yourself. So later on, once these situations happen, you're going to be able to execute on these, and someone new is going to look at you and say, oh, hey, man, How are you able to do that? And you're going to say, oh, well, it's easy. Just give your trade a second chance. And they're going to say, oh, how? So these situations can also happen. Now, there's another situation that happens all the time is when, the next candle breaks below the low and just continues to push up. These scenarios are where you can't really give your trade a second chance because there was no confirmation. And always remember, whenever you're giving a trade a second chance, there needs to be a confirmation. There needs to be a logical way where you can execute that trade. Okay? Very, very important. Giving your trades a second chance. And also rewatch this, right? The rules were you have to have the same bias. Don't change your bias. Changing your bias is going to be very, very risky. It's going to be detrimental to your mental health. It's going to be detrimental to your trading psychology as well. Never change your bias. I have a lot of people who can successfully give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Let's take a look at this right here. Now, this basically, fits in perfectly with giving your trade a second chance. So we're going to talk about that, how to add risk back. Now, whenever we're talking about how to add risk back, it's basically after we've basically managed risk, and when price starts to go back in our favor, that's when we're saying that, okay, we're going to add risk back to the trade now. So let's take a look at this. All right, so in this case, we're going to talk about, so we're going to go over some, like a bearish trend. Let's say we have a bearish trend, price is coming down, you have a bearish candle, and then over here as well, you have a bearish candle coming down. We have another bearish candle, move down, another bearish candle, move down. And then we have a bullish candle forming, we start to go up. We've created let's say a hypothetical support. We have another bullish candle that goes up, and that's basically it, right? And then we have a bearish candle forming. Boom, resistance formed, trend is down, you're anticipating price to go down. This is, let's say, a 40 pip range, and you're anticipating price to continue pushing down. Now, all of these scenarios, they do happen when price is trending, right? So in this case, price is trending bearish, and this is what we're going to go over. So let's say you take a sell, and instead of pushing down, price starts to go up. Now, the most important thing here is for you to really understand how managing risk works, right? And that's what we've explained in the risk management section, the third one, and also in the risk management 3.0 in market fluidity. So you have to go over that first, okay? You have to go over that first. Now, for example, let's say we're looking at the 30-minute time frame, right? We're looking at the 30-minute time frame, and let's say all the 15-minute candles are also bearish. So let's say this 30-minute candle consists of two 15-minute candles, which are basically, like this. You got two 15-minute candles that are basically like this. You take a sell at this point. You've taken a sell, and price wicks up. When price is wicking up, and in this on 15-minute, let's say price is wicking up and moving up, once it starts to break the high of the previous 15-minute candle, you're like, oh, okay, wait a minute. We're breaking the high. Maybe at this point, now two scenarios, right? One, if we close bullish, I have to manage risk. Or if it breaks the high, I have to manage risk. So you're managing risk. You're closing 50%, right? You close 50% risk right there. Let's say you had a one lot. You're closing 0.5. So now you have 0.5 left open. You have 0.5 left open, you're like, okay, you know what, I don't know, I don't understand whether the price is going to continue to push down, it's going to push up. So either way, you managed risk and you closed 50%. Once you've closed 50%, now you're waiting to see how price is really going to move, right? So let me remove these lines over here because we're going to be using this as well, right? So let's say now the 30-minute candle, it starts to close bearish. And what it looks like over here is that the 15-minute candle, it starts to push on, moving down. Now we've closed bearish here on the 15-minute. And as you can see now, we've created a minor support on the 15-minute, okay? We've created a minor support on the 15-minute, and also the 30-minute candle is moving down here a little bit too. So when we're moving down in the scenario, now you can look around and say, okay, hey, wait a minute. I still have, let's say, a 0.5 lot running, and if the next 15-minute candle breaks the low of the previous one, maybe I can add the risk that I closed. So in this case here, you can add your 0.5 lot back, you know, and your stop is either going to be, it can be above the 15-minute candle, or like, you know, it can be above the current 15-minute candle that's just forming and breaking below the low. Now, there are a lot of things that can happen here, right? This 15-minute candle, you need to have volume to push price down. And this 15-minute candle can just move down without making a top wick in the first minute, first 5 minutes, 3 minutes, 4 minutes. So that's all on your intuition. That's all on your judgment, how you're going to perceive that. But this right here, we're talking about the fact that once we've made a top wick and we've broken the low, that's the perfect scenario to add risk back to your position. As we start to break the low, you can add position back. You're like, okay, you know what, I'm going to add it back. And on 30 minutes, it looks like price starts to go down. Okay, but the most important thing is that you are managing risk. You're actively managing risk, and once price starts to form in your favor, you're adding that risk back. So that's how it works. And there are also various variations to this. The number one variation is that if, let's say, for example, let's say the 15-minute candle broke above the previous high, and the new 15-minute candle, when it forms, it just starts to drop down. You know, once it starts to drop down on the 30-minute, it kind of looks like this, okay? When this happens, there's basically no way for you to add risk back. If you look at this, right? Because the 15-minute candle, you know, this broke above the high, you manage risk. Next 15-minute candle broke below the low, and it moved so quickly, you're like, oh man, I couldn't manage risk, so I took the trade, whatever I could take. You know, that's why sometimes you can see if you're going to have a one lot and price moves, let's say 100 pips, and you've managed risk here, you, instead of making $100, you make like 50 bucks because you let the 0.5 run till, you know, 10 pips or whatever. But some people are more advanced. Some people are more, you know, experienced. So what they're going to do is they're going to say, okay, you know what? If the 15-minute candle is breaking below this low, and 15-minute candle breaking below this low also means that the 30-minute is breaking below its own low as it starts to go down. That means with volume, there's a higher probability we can continue to push down, and that's where they can probably take an impulse entry to say that, okay, we wicked up, I managed my risk, now we're breaking below this minor support, impulse entry would make sense, so I can add risk back to this trade for price to continue pushing down. Make sense? So you have to re-watch this again. You have to go over this. You have to look at examples. The best thing to do is to look at all the losses you've had in the past, all the losses, and look at those trades and then really ask yourself that, okay, if I took a loss in this scenario, where could I have given my trade a second chance? What could I have done differently so I could have given my trade a second chance? Or there are also multiple scenarios where you managed risk and price still went in your favor. Now, sometimes people over-manage risk, right? Over-managing risk is that you're going to basically close 50% right here, and the next time it goes up, you're going to close another 50%, and Before you know it, you only have like 10% running, and 10% that runs, that profit sometimes isn't enough to cover the loss you had closing in negative, okay? So over managing risk, don't do that. If you're going to over manage risk, do it only twice. Close 50% once, then close 50% twice. That's it. Don't close more than 2 times. Because if price is going to go in your favor, it's going to go in your favor after that one time you manage risk. If it's going to go in your favor. If you manage risk the second time and it still doesn't go in your favor, just close the whole position. There's no need for that. Because if price then goes in your favor later on, you can give your trade a second chance. Make sense? Right? It's all logic. So go over this virtual class right here. Go over these classes. There are different scenarios that happen. And also remember, adding risk back to the trade and giving your trade a second chance. They go hand in hand. They are very, very similar. They're very, very similar ideas. Giving your trade a second chance and adding risk back to the trade. They are very similar ideas, and you have to wait for candles to print exactly how you want to see them printed. Now, for example, some things can also happen like this. Let's take a look at this right here together. Sometimes what can happen is that candle is closing bearish, and you're like, okay, candle closing bearish, I'm going to take a sell over here. You take a sell here, and what happens is that next candle, it breaks above the high of the previous candle, right? You get stopped out, and then the candle forms like this, a weak bullish candle. A candle forms like this after you get stopped out. After you got stopped out, and we're still in a bearish trend, and we're still closing below this resistance. Remember, this is a resistance, right? If we're closing below this area, now you know what's the higher probability. The higher probability is if the next candle wicks up and it breaks below the low of this candle, we all know what's going to happen. There's a higher probability with volume we can continue to push down. And that's where you can give your trade a second chance as well, right? Impulse entry. Most of the time, impulse entries are great to give your trade a second chance, adding risk back to the trade, and so on and so forth. Okay, but the main thing is you have to wait for candles to print exactly how you want them to print. That's very, very important because you have to see the exact scenario and then you have to execute on this. Because remember, guys, you're trading with money and this is real money. You can't play around with your money. You have to wait for candles to print exactly how you want them to print. Sometimes, we can look at the candle and say, oh, I have a feeling it's going to move a certain way. Or I have a feeling it can go in a certain direction, so let me just take that trade. Low risk trade, but let me take that trade. But once that trade doesn't work out, your ego's hurt, your confidence is hurt, and things basically go downhill psychologically from that point. So you have to always wait for candles to print exactly how you want them to print. All right, again, remember, giving a trade a second chance and adding risk back to the trade, they go hand in hand. They work together, okay? Whenever you take a loss or whenever you manage risk and you're like, okay, you know what, I've managed risk, now I'm ready to, accept the risk that I've taken in the beginning, and the price doesn't stop you out and starts to go in your favor, you're looking at different scenarios to see that, okay, does this make sense where I can give my trade a second chance? Because remember, it has to make sense, right? Whenever you're giving a trade a second chance or whenever you're adding risk back to the trade or a potential move, it needs to make sense from a technical perspective. Also from market structure, it has to form in a way that you recognize that it does work. Now, again, as I mentioned, it does take time. It's not going to happen overnight. You're not going to get really good at it maybe in the next week. Man, I'm not even perfect at it. I'm still sometimes, when price goes in my favor, I'm still kind of hesitant to maybe give it a second chance, but I still do. Most times when I still do, it does go in my favor. Sometimes it doesn't. That's the probability of trading. So you have to give it a chance. You have to just watch how price moves. Whenever you take a loss, step back. Relax. If you managed risk, be happy about it because a managed risk trade is a winning trade because you lost less than what you planned on losing. Now, go over these things, go over the section again, and look at your losses, look at the trades where you closed early. Now, sometimes guys ask, hey man, listen, I closed my trade early, what could I have done? And the answer is very, very simple. Whenever you think you should be closing a trade early, close, let's say 90%. or close like 50%, whatever, right? We've discussed that as well. So take care, everyone. Go over this section and always go over your losses. And you're going to be surprised how many things you can find in them. Take care. Welcome, everyone. So today what we're going to talk about is when to wait for a 15-minute confirmation versus when to wait for a 30-minute confirmation. This is very, very important because a lot of time, like, when price is moving, or let's say if price is breaking out of resistance or breaking down below a support, and the 15-minute candle is closing and the 30-minute candle is about to start, and you're thinking, should I enter at the 15-minute candle close? Should I enter on the 30-minute candle close? Now, the thing is, there are a lot of different variations that can occur, right? So the best thing to do is what I always talk about is to see how price moves, how price breaks through zones, when it's a 15-minute candle close, 30-minute candle close, what happens, like, and over time, then you start to develop this intuition, right? And that's what we call experience in watching candles move. And then you're able to determine whether, okay, I should be waiting for the 15-minute candle to close right here and then execute on the 30-minute, or I should wait for the 30-minute candle to close and then execute after the 30-minute candle closes. So we're going to get right to that right now. Okay, so we're going to keep things extremely simple. So we're going to go over like simple basics. I'm sure we already know about the basics. We already know about wicks, how candles move, how candles close. So we're going to go over some different scenarios where you're able to see whether you should wait for the 15-minute or you should be waiting for the 30-minute candle. So okay, so for example, let's say we have a support area, right? We got a support area and we have a candle, which is, for example, we have a bearish candle at this point and it has a big wick down at the bottom. Now, for example, let's say we're looking at the 30-minute time frame, okay? We got a 30-minute time frame, we have a candle with a wick that broke below, and now we have a wick at this point. Now, when you're looking on the 15-minute time frame, what you're going to see is you might see that on the 15-minute, a candle is bearish at this point and it's coming down, right? Now, if this is the first half, let me write it right over here. If this is the first half of the 30-minute candle, we know that this candle has to close for us to determine whether the 30-minute candle is closing or not, right? So once the 15-minute candle looks like this, you got a wick to the left-hand side, which maybe corresponds to kind of like the same wick here to the left-hand side. Now, once the 15-minute candle has closed at this point and the 30-minute candle is still open, and that's going to look like something, let's say, like this, right? So 30-minute candle is still open, and 30-minute candle is open, 15-minute candle has closed. Now, in this scenario, what do you think? What do you think, right? The 15-minute candle has closed below support. There's a wick to the left-hand side. The 30-minute candle is still open, and there's a wick to the left-hand side. The most important thing is to understand wicks, right? Wicks, wick rejections versus wick fills. We've already talked about the difference between wick rejections and wick fills, right? So, okay. The 30-minute candle is still open. The 15-minute candle has closed. The 15-minute has closed below support. This is not a strong confirmation that the next candle is going to go down because the 30-minute candle is open. And as the 30-minute candle is still open, it can reject from this area, right? You have to understand, if the 30-minute candle came down, we rejected this area, this current candle also has the probability to reject from this area, which means that the next 15-minute candle can potentially wick down and then move right back up. Okay, if it's not going to move right back up, what there's a probability about is that the next 15-minute candle, it may go bearish and it may reject this area as well. So this is not a strong confirmation. So in this scenario, you have to wait for the 30-minute candle to close, because let's say if the 30-minute candle closes like this, now you have a strong enough confirmation that the next 30-minute candle, it may wick up and then continue on pushing down because the 30-minute candle itself, it closed below support. So in this scenario, you have to wait for the 30-minute candle to close because there's a rejection here to the left-hand side. For example, second thing, if let's say there was no rejection, right? Let's say there was no rejection and the 15-minute candle closed below these candles right here and the 30-minute candle is still open at this point, then this is a good opportunity to take the 15-minute candle close as a good confirmation that the next candle has a higher probability to continue down. Make sense? So if you're taking notes, like, okay, you have to take notes. If you're taking notes, this is important. What we talked about is, I'm going to repeat this again. Number one, if you have a rejection to the left-hand side, okay? We have a rejection to the left-hand side, and the 15-minute candle closed in this rejection area, and the 30-minute candle is still open. This is not a good confirmation to take a sell because the 30-minute candle is still open. We don't know whether the next 30-minute candle or whether this current 30-minute candle is going to reject like this and maybe go up or not. We don't know that, right? So that's why it's important to wait for the 30-minute candle to close if we have wicks to the left-hand side. The same goes true if price is moving up. If you have a wick rejection to the left-hand side and the 15-minute candle is open and you're waiting for the 30-minute candle to close, okay? So whenever you have wicks to the left-hand side after price is breaking, let's say a support or it's breaking above a resistance, you need to wait for the 30-minute candle to close because that's going to give you a much stronger confirmation that price can continue pushing up. Very important. And this is the difference between winning and losing because, if you have a 30-minute candle that's still open at this point and we're bearish and the 15-minute candle has closed, and let's say you take a sell, okay? Let's say you take a sell right here, and the 30-minute candle starts to reject and starts to go up. What are you going to do? It's going to be a loss because you entered prematurely because there were low confirmations. You didn't wait for the 30-minute candle to close. So whenever you have a wick rejection to the left-hand side, I would say just wait for the 30-minute candle to close because then you're going to get a very strong confirmation that price may continue pushing down. Now, someone may ask, okay, Raja, let's say the 15-minute candle closed bearish like this, and on the 30-minute candle and on the 30-minute time frame, the candles look something, like this. We closed in this scenario right this. What are you going to do? The best thing to do at this point is to obviously take a sell because we closed below support. The previous candle rejected this area and closed above support, but this 30-minute candle was so strong, it had such great volume. Yeah. This is only going to be possible when there's volume in the market. You got your pre-London, you got your London Open, you got your pre-New York, New York Open, NYSE. Like we all know the times when there's volume in the market. This is only true when there's volume in the market. You have to wait for the volume in the market. Now, when the 30-minute candle closes below, you're like, okay, let me take a sell. The sell, let's say your stop is above the 30-minute, and let's say this is a 25 pip stop or a 30 pip stop, and someone might say, okay, you know what, that's a very, very big stop loss. Then maybe you may want to have stop above the 15-minute candle to keep the stop smaller and then anticipate the next candle to continue pushing down. So this is where you're basically not waiting for the 15-minute to close and waiting for the 30-minute candle to close. Okay, so let's go over again the example where we talked about what's the best scenario to wait for the 15-minute candle to close. So let's say again, okay, so in this example, we're going to talk about, let's say we have a resistance, right? So you got a resistance, we have a candle that was bullish, and it rejected this area right here. This is a 30-minute time frame, and now we're looking at the 15-minute time frame, which looks like this. Okay. Oh, actually, no. Let's say this is a smaller wick. There's no rejection. 15-minute candles like this. Right now, if the next 15-minute candle we break and close above, and now the 30-minute candle kind of like looks like this, but it's still open. The 15-minute candle has broken and closed above. This is a good opportunity for you to say, okay, you know what? We don't have a rejection to the left-hand side. We have a candle that's closing above a resistance. There's pretty good volume coming up. So now I think there's a very good possibility that the 30-minute candle can continue pushing bullish. And then you're going to say maybe this is a great idea to take a buy after the candle has closed above resistance. okay? But if we had a wick rejection to the left-hand side, let's say like this, then we don't know whether the 30-minute candle is going to close above or not. Because the previous candle went above resistance, it rejected this area and closed below resistance. So we need some strong confirmation. So in this case, when we have rejection to the left-hand side, you have to wait for the 30-minute candle to close, right? Which will mean that you're waiting for the next 15-minute to close, which may close, you know, something like this or whatever it may close. We know that the 15-minute confirmations are low or like weak confirmations when you have rejections to the left-hand side. So let's say the 30-minute candle closes like this. Now you have strong confirmation that the previous candle could not close above, and this new candle closed above this area, which means now you have a very good confirmation that the next candle has a higher probability in time of volume to continue driving bullish. Make sense? You may have to watch this over and over again and then kind of like see, you know, if this makes sense or not. Now, we're going to talk about another scenario here, because there are different scenarios and the candles form in different ways, and, you know, candle closed in different ways, and 15-minute candles and 30-minute candles, and you got to take a look at the 1-hour time frames and 4-hour time frames. So we're going to take a look at another scenario over here. Let's say, for example, you got a resistance right here, and you got a 30-minute candle that closes above resistance, okay? You got a 30-minute candle that closes above resistance. That's perfect, right? That's perfect, because now you got a candle that's closing above resistance, so this gives you a good idea that there's a, okay, let me put this right here. Now this gives you a really good idea that there's a high probability for the next candle to continue up. Now if we look at a resistance in this area, the 15-minute candle is probably going to look something like this. You got a bullish candle coming up 15-minute, and then you got another 15-minute candle that moves up, and you're like, okay, there's a high probability for the next 30-minute candle to continue driving up. So that's a really good buy indication, because you waited for the 30-minute candle to close above this area, and, you know, if there's volume, price is going to continue to push up. All right, so it's very simple, not that hard. All you got to do is pay attention to see how candles are moving. Very, very simple concept. Great idea to just simply watch and see how price moves in the beginning. Because in the beginning, you may not get it 100%. In the beginning, you may be like, okay, you know what, I'm going to wait, I'm not going to wait, and sometimes you may miss trades, you may miss moves, and trust me, man, I've missed so many trades like this just to get it right. So again, we're going to recap the whole thing again. If you have rejections to the left-hand side and there's a big wick, you have to wait for a higher confirmation candle or a higher time frame candle to close in that zone, because only then that wick rejection is going to become a wick fill. We've talked about that in other webinars as well. So I hope this little topic was helpful. Now I know it's going to take some practice. It's going to take some experience as well for you to like sit and watch price move. Sometimes you miss moves. That's totally fine if you miss moves, because a missed move is an opportunity to learn. A missed move is an opportunity to gather the information and put it in your arsenal, and then the next time it happens, you can execute on it. So take care. If you have any questions, of course, you can reach us, or you can, yeah, it's just me. Or you can reach me in the Slack, private DM, in the channel, or whatever, tag me, and then we're going to answer some questions. So take care.